Hey guys, welcome back to another video of JB&D's Market Snips. It's been a while since we've gone through some reading, some stuff that I've sniffed out for. Um, Last video went over things we can improve on for this new year, and a big thing that I mentioned was I was gonna buy a whiteboard planner. However, I didn't do that. I was like, where am I gonna place this? Because I already have a big ass whiteboard on one of my walls, and it's just gonna look too messy. So then I started looking at the notebooks, and there was one notebook planner in particular that I found interesting, that I really liked, but it was like 24 bucks. And then I was thinking like, it's nice, but I don't know. So what I decided, I took a few photos of the pages to get the layout of it, because I really like how basically it has you write down like three goals for each day or for the week, and then for the month as well. I don't know, it's pretty cool. um so I'm gonna just do it digitally. I'm gonna copy that layout and make a digital planner, and I'm gonna yeah, it's gonna be fun like that. Another thing, it's been a rough start to the year. Yeah, a really rough start, like outside of all of this, and personal issues, relations, situations, things like that. Um, just take care of your health. Um, and one thing that I used to really struggle with in the past was not being in the present, always thinking about the future, always worrying about something, or always living in the past. So really try to uh, be more present, okay, in the present. All right. Um, yeah. Anyways, so I hope the mic sounds better. Last video was very, there was like this static sound. I think I figured it out. I think it was just the cable touching the wall. Um, I hope, because I'm gonna be really upset if it's making that sound again. I'm not gonna record this all over again. So what else? What else? I got this LED light, and it's for better lighting, right? But now my glasses are, god damn it, I hate it. I hate it. Um, Supposedly there's like a thing that I could put on the lens of this little camera that'll like reduce the glare. I have to go on Amazon and see if I could find it. But yeah, let's get into it. Let's get into it. Yeah, yeah, yeah. Okay. All right. Where we left off was here from the last video, 11 days ago. Now let's go from here. Okay. Foot traffic trends reflect that search for value, discount, and dollar stores, wholesale clubs, off-price retailers, and thrift stores were some of the most visited stores on Super Saturday. Placer AI found shoppers have shown themselves to be more discerning this holiday season, and Super Saturday was a key example of consumers being more selective in their final shopping trips before the holiday. By all accounts, markets accounted for budget-sensitive consumer this year. Something that we've been on for a couple of months now. I have been buying some Kraft Heinz stock, um, in the Roth IRA. What else? I have. We're playing Ibotta through that as well. It's a little bit riskier, but yeah, those are my two plays for that. Higher foreign demand for U.S. assets in 2025 than in 2024. Okay, this is something I want to point out. Foreign demand was still high. Okay, and then right here, it's striking that the US dollar managed to weaken in 2025 despite significant foreign buying of US stocks. What will happen to the greenback if those equity inflows turn into outflows? So I don't know if I mentioned this last video, no, not 2 videos ago, where the I mentioned the game plan for 2026. Part of the thesis is also a weaker dollar, that will boost international markets, hence the China, hence a lot of my long term plays have international sales. Um, but like okay, like the main focus for this video is going to be the yen carry trade, but really the yen reverse carry trade. Okay, so oh my god. Okay, let's. Where do I really start? Where do I really start? Because you've probably heard about this, but and you probably hear about this frequently, and it never leads to anything. But it's there, it's there, and even I thought about this too. Like, I would hear about the yen carry trade, the reverse carry trade, or whatever, whatever. Oh, they say this, they say that, but nothing ever happens, right? Nothing ever happens. Okay, well here, hedge funds are extremely bearish on the Japanese yen. Leveraged funds held 85,000 contracts of net short positions on the yen in the week ending December 14th, the second highest since July 2024. This marks the second consecutive week of heavily bearish positioning following 92,000 net short contracts recorded in the week ending December 9th. Okay, so this is a few weeks old, so but that's still very high, okay? So hedge funds are extremely bearish on the yen. You go on Twitter, everybody's extremely bearish on the yen. Um, the BOJ hiked December 19th, and the yen was still dropping, and everybody's bearish about the yen. That the yen is still dropping because of concerns of Japanese debt and government debt and all this stuff, right? Which could be true, but I'm just trying to point out that sentiment on the yen is very, very low right now. Okay, so I saw that graph of hedge funds, and then I just go and I check out the charts. Okay, because what I like to do is I like when the fundamentals and the charts set up perfectly in tandem together. Okay, and in this case, I saw the yearly chart, and the yearly chart has a perfect inverted hammer candlestick. And if you don't know what that is, this is what it is. Okay, it's the opposite of what a hanging man candle is, and hanging man is honestly, without doubt, without even have to think about it or anything, my favorite candlestick setup for a short or reversal position. Um, why? Because the risk to reward when you play hanging man is one of the best ones that you'll ever find, because the candle closes near its open, right? And the risk or stop level that you should usually have is above that candle's high. Okay, so you would usually place your stop above the high of this hanging man candle, which is very tight because the candle, first off, closed near that high, anyways. And that downside is, oh, the risk to reward is amazing. And it's the same thing with the inverted hammer, exactly the same thing, just the opposite direction. So you're really risking nothing. You're risking very little. Okay, I'm risking very little when I play these types of setups. Um, and again, nothing here is financial advice. All of this is my opinion. Um, so this is all for educational purposes. I'm not responsible for any financial decisions. Speak to a financial advisor before you act on anything. Um, okay, yeah, that's the yearly. The monthly had something similar. Um, has this doji, but I like the yearly candle better. It's much better. You see, imagine all that upside. Okay, that's the technicals, right? That matched with hedge funds being extremely bearish. I had to do some more digging. Okay, so I had to like, cause it has been a while since I really paid attention to it. Cause again, nothing ever happens. But when I saw those two things, I was like, okay, this is worth doing some more research. Um, this is a nice thread explaining, trying to simplify the carry trade. Um, but here's my comment right here. Is this going to be an easy layup? Whilst there's fear in the yen, the setup is still there for the reverse carry trade. Technically and fundamentally, the U.S. will get a new Fed chair that will likely cut rates. Okay, the current president will probably appoint somebody that's going to cut rates as much as he wants, and that lessens the advantage in the carry trade. The Bank of Japan is hiking. They probably still hike again. and overvalued big tech can see profit taking, because a lot of the carry trade money goes to these big tech U.S. companies. Once they'll see, and they're already at outrageous prices, so those could see profit taking, which could see an unwind in those prices, which could see these carry trade traders selling those positions and then going back to the yen to pay off their loans, pushing the yen higher. It will make more sense. Let's just go over this thread, okay? By the Ultimate Ultimator 5. That's their name. Um okay, so you borrow yen to convert to the US dollar. And when traders borrow yen for this carry trade, it pushes the yen down, okay? This is more about the yen, less about Japanese yields. It's more about the yen, okay? Because Japanese yields have been going up and the yen has been going down. You would think since Japanese yields are going up, there would be less advantage in the carry trade, which would see the yen up, but that's not really the case because Japanese yields have gone up, but the real rates are not. I I, I don't know if they're actually still negative. Um, Let me see. And I just noticed that I'm on the other tab, on the other window, which means you can't see all this. Okay. Uh, Shoot. Sorry. Let me move this here for you, so you can see. Okay. Yes. Even though the BOJ ended its negative interest rate policy in March 2024 and has raised rates, real interest rates in Japan remain deeply negative. Da da da. Okay. I should probably fact check this, but I read it somewhere else, and I'm not gonna waste my time. I know I should though. So if you want, again, nothing, none of this is financial advice. It's all opinion only, and you should really double check everything. Okay. Um. Okay. The yen carry trade can be simplified down into 5 steps. Borrow yen. You convert it into dollars. You buy or short sell assets. Then you pay off the debt with that profit, and you keep a profit. Okay. So here, you borrow the yen, again, pushing the price of the yen down. You convert it to US dollars because you're selling yen to buy dollars, which pushes the price of the US dollar up. Okay. And then you could go buy US companies or sell short companies. I say US because that's where most of the money goes to, as you saw in that previous graph. I'll show you again, so you know what I'm talking about. Okay, higher foreign demand for U.S. assets. Okay, foreigners are still buying U.S. assets. So you go back here, whatever, you check your profits, you convert it back to yen, you take your profits. Okay. Um, Now since the yen has a very low borrow fee, you can simply borrow yen highly leveraged at almost no cost, convert that into US dollars, then use that currency to invest. Since it's so cheap, all institutional buddies are leveraged, okay, on the carry trade. Okay? So you're parking your profits. However, however, um so this is what happens, like I said. So whatever, let's say, let's forget about the short selling. Just focus on, because mostly people will buy usually. So they have their profits on Nvidia, Mag 7, all these big US tech companies, okay? Then they convert those dollars back into the yen because they need to pay back their yen loans, okay? But when they convert back into yen, there's more demand for the yen, so the yen goes up, okay? And then the dollar goes down. I would assume the dollar would go down. Um and so then when they pay off the loan in um the yen would go up, right? But the reverse carry trade hasn't really happened yet. Okay, the yen is still going down. The dollar has gone down despite foreign demand for U.S. assets, which is an orange or red flag. Okay. Um. Again, here selling the yen for U.S. dollars makes the yen weak versus the dollar. Strength of yen declines, which makes it cheaper for everyone else to pay off their loans. But if the yen goes up, it makes it more expensive for people to pay off their loans again. Okay. So since the interest rate is so low, it's almost a guaranteed win. As long as the unrealized gains outweigh the cost of borrowing in the yen. You're so highly leveraged, so small risk changes in either the strength of the yen or your investments or the rate could be very bad. Okay, so any slight little change could be bad because of the leverage all these investors are using for that. Okay, the first pass, the first possible bad scenario for you is that investments start going the wrong way. This means that longs start dropping and shorts start gaining. You are now holding unrealized losses. Okay, so the first bad scenario could be that those investments, those U.S. investments start going down. Okay, um, and in that case, for example, let's just say Mag Seven. Okay, again they're already out at these absurd prices. If investors start taking profits, that could push the price down, which could then also bag these carry trade traders, which could then force them to sell and then convert back to the yen, which pushes the yen up. Okay, so you have a cheap borrow fee because it's very low interest rates in Japan, and you could get higher returns in the U.S. equities because they just go up. They have been. Um, I don't think they will continue to, at least these big tech companies, and you have higher interest rates. Okay, that's a big reason why foreigners buy U.S. assets because of our higher interest rates compared to other countries. However, if Trump places this handpicks his Fed chair to be someone that's going to cut rates as he likes, then we could get lower rates, which could lessen that advantage of the carry trade, which could give less, which could make investing in U.S. assets less appealing because you have fewer, you have lower rates. Sorry. Okay. So let's say these stocks go down, so they don't get profits, they have losses, so they have to convert back into yen from U.S. dollars and pay off the loan, which pushes the yen up again. Okay. In order to pay back the loan, you need to sell more assets to convert back into yen. When you convert back into yen, this creates demand for the yen, which increases strength relative to the US dollar. This makes it more expensive for everyone else to convert back now. So the US dollar is already dropping. And this is related to worries about US government debt. Okay? Now imagine when the reverse carry trade happens. My goodness gracious. You know what? Last year, I was texting my friend. I was telling him, "Hey, the dollar's probably gonna drop. I want to buy some. Push. I want to park some cash in a different currency. In this case, it was the peso. The peso was up like 14% this year, or it was up 14% approximately for 2025. I didn't do it. I didn't do it because I thought I had to create a bank account in Mexico. In that case, I needed to have either a residency there or um, the citizenship, which I don't have in Mexico, and so I didn't do it. But comes to find out, I think on IBKR on Interactive Brokers, I could just convert. And I was like, man, I missed out on 14%, or whatever. So in order to pay back your loan, oh yeah, we were talking about this, right? So you don't get profits, you have losses instead, so you have to convert back before you lose even more. You have to sell more assets, because you have less capital because it went from profits to losses. So now you need to sell other assets that you're holding to get to gather more capital to pay back off your loan. Okay, and then the yen goes up, which makes it more expensive for everyone else to pay off their loans. So then the yen goes up, and then more people start panicking, seeing the yen going up, which means more people need to start selling their positions to convert back to the yen before it goes even higher. And then yen goes up, these assets go down. Okay, dollar goes down, yen goes up. At first, this could affect the whole market. Um, Look, when was it? There was like a slight version of this that happened last year in July, August. No, not last year. 2 years ago, 2024 now. Okay. So at first, it could affect all equities all over the world, right? Um, if it really gets bad. But after the storm, when everything settles, this would actually, in my opinion, be bullish for international equities again, because the the carry trade would have unwinded, the reverse carry trade would have taken place. These investors would have gotten rid of their U.S. positions. Maybe this could have, so this could have been from just profit taking, or just negative catalysts on the Mag 7 that catch investors off guard. It could also, or it could be again like the interest rates are lowered, um, with the mix of that as well. And there was another thing that happened. I forgot. Um, but at that point, if U.S. rates are lowered, again, there's less incentive for investors to go to the U.S. and they'll look elsewhere. They'll look at other countries. The dollar would have gone down probably. So again, this gives room for emerging markets. You, in my opinion, you're going to be seeing a big diversification. Okay, globally in performance. Um, so something to watch out for. It's something I tweeted about a few days ago that I want you to notice the um the market broadening, the performance broadening in the markets, but not I'm not talking about sectors in the US. I'm talking about globally. A lot of a lot of countries internationally outperformed the US this year. Okay? And again, I think this is an early sign of investors finding their new toys. And once this carry trade happens, the reverse carry trade happens, it's only going to speed up. Okay? Maybe Alibaba gets caught in the crosshairs at first, but it would recover. However, the last time this happened, um, in July 2024, Alibaba was fine. But again, I don't know. Um, so again, always have a plan. Stay prepared. So when push comes to shove, you respond and you don't react. Okay. And again, I'm sorry. Sometimes I just explain things very slowly. Sometimes I could have kept things way shorter than I do. Sometimes I just add on unnecessary repetitions, um, whatever. I just repeat things unnecessarily sometimes, like I am right now. So I recommend you just increase the playback speed 1.5 or 1.8 or 2, whatever is best for you, as long as you're still able to process everything. Okay. Now, another scenario is that either the yen interest rate increases. This means that more US dollars need to be converted back to yen, creating a spike in the yen buying and less borrowed demand. this has the same impact as before and increases the yen's strength. So in this case, the Bank of Japan would need to hike rates dramatically. Um, and they hiked rates in December, right? Yen still went down, so they might take this as a sign to need to cut rates again. I mean, hike rates, um, even more so. Um, so that's a possibility. Okay, what would happen then? Then they get a higher interest rate, and while in the same time, U.S. rates are also going down. So U.S. rates are slightly going down. Japanese rates are slightly going up, right? So that gap is what investors like about the that gap is what creates this carry trade. It's what insensitizes, and God damn it, it's what gives traders the appeal for the carry trade. And as that gap closes down, that appeal goes away. It goes away, and then there's less incentive for these traders to play this, and then things reverse. Okay, so less incentive to borrow then convert yen into US dollars, which means less demand for US dollars, causing yen to stop weakening as quickly. So again, they convert back to US dollars. I mean, they convert original US dollars back into yen to pay off the loan in yen, which pushes the yen up again. Okay. Um, and how do they convert their original US dollars back into yen? Well, by selling their assets. They have to sell their assets to get cash. And what are those assets? Again, these big tech companies. Okay. As the strength of the yen increases, it becomes increasingly more expensive to pay off debt, causing everyone to start unwinding other assets to pay up. This creates a death loop where everyone starts to unwind. Okay? Because other traders, investors see the yen start going up, they know it's they got to start selling their assets to convert back into the yen, and it's just okay. So yeah, I really like this explanation. I want to repost this. Let's close that. What is this? Oh, okay. Well, since we're there now, I might as well keep going. Yeah. So again, and the dollar dropped this year with with foreign demand still there for U.S. assets. Imagine when foreign demand goes away, this dollar. Oh my goodness. Oh my goodness. You just gotta really think about these things. That means the dollar has much more room to drop, which means international markets, emerging markets have much more room to outperform. This is a multi-year play, man. Um, yeah, institutions are reducing dollar exposure. Here, wait. Well, let me make sure I have everything. The dollar spot index down 8%. Worst year since 2017. Okay. I want to make sure I've covered everything about the carry trade, and then yeah. So what I saw this last night, all about the yen. I saw the technical setup, and I checked the fundamentals again, and everything's still there intact for the reverse carry trade. And I was like, you know what, 1 plus 1 equals 2, and so I took a long position on the yen last night on the futures, and we'll try to swing it. We'll swing it. We're ever since we bought, it's been going up. Last night around 0.006401 5, something like that. So we got a good entry. But yeah, it's all about the timing, man. So, but that setup looks amazing. Okay, let's move on now. All right, let's move on. Let's see. Well, I want to talk about this since we're on the topic of the dollar. Here. I don't know if I talked about this in a previous video, but if I did, let's talk about it again. I got this from Ray Dalio, um, from his work, and then I kind of just rephrased these different phases that he mentions in his work. First phase: U.S. bonds pump, dollar weakens. The dollar won't follow U.S. bonds upwards because it's due to inflation and policy failures, creating a loss of confidence in the Fed, which can weaken trust in the dollar. So there's a loss in confidence in the Fed and government's ability to pay back its debt, um, as well as this whole circus going on with the new Fed chair for 2026 and Trump. So dollar's been going down. Bonds have been stable. Second phase is where U.S. bonds dump and the U.S. dollar weakens as well. So that might be that might be. I still think we're towards the end of the first phase. Okay. Um, that second phase might be when I think that's after the reverse carry trade happens. After the reverse carry trade happens, investors start to notice that there's better opportunities elsewhere. There's less demand for US assets, equities, and bonds. And that's when we see both the dollar and bonds dump. That's what I think, okay? Less lending to the US will cause panic selling of the dollar, further weakening it and bonds, as well as money moves to foreign currencies, bonds, and markets, okay? Money moves to foreign currencies, bonds, and markets, okay? And third phase: political extremism, increased wealth gap, and civil war revolution. Off topic, but have you noticed that the media, whoever the fuck controls all this shit, has been trying to like slowly get the idea in our head that there might be a civil war type thing going on in the USA in a couple years. Remember that movie that the Obamas helped direct or produce? Um, what was it called? I forgot, but it's on Netflix and similar to that. Then there was a whole Civil War movie a year ago, and it's honestly pointing to that. Like, dude, I don't want to get too much into this, but I just want to say, I just want to say, we are further being divided, and dude, basically, when it comes to like, now this, hmm, nah, I'm not even gonna go into this. They think the debt is manageable because of foreign and domestic demand. But what will they do when that demand vanishes? I'll come back to this topic at a later time though. I think that's phase two. We're still in phase one. Okay. So let's read this. I don't know if this was from Bank of America or this other bank. What's that bank? USB or something like that. Yeah, USB, something like that. So they have, okay, a surging federal budget deficit that unnerves investors and spooks the bond vigilantes. Deficits in the long run do matter. Da, da, da. Not calming any nerves. However, against this backdrop, we continue to believe that the government's finances are manageable due in part to one, strong underlying demand, foreign and domestic, for U.S. securities, and two, the fact that government finances are backstopped by the world's most dynamic economy in the world, at roughly 100% of GDP, gross public sector deficit. Okay, so one of the reasons is strong underlying demand, but what happens when that underlying demand goes elsewhere? And it's going to eventually, very soon, in my opinion, very soon, is between now and Max 4 years. I would say. I think. I think. Could what if I could be wrong. It could be way later. Um. But yeah. Anyways. AAII. Bears fell to 27% this week, the lowest since October 2024, and the first sub 30% reading in over 30 weeks. Optimism is no longer scarce, and a bullish 2026 is increasingly becoming the best case. I don't know about that, but fell to 27% this week, the lowest since October 24. First sub 30% reading in over 30 weeks. Uh, Last time it happened here, what we still went on. So that's interesting. They don't really lead to a market top, but I'd still be wary because if mostly everybody's bullish, I don't know. But then again, just let the numbers speak for themselves. So interpret this as you want. Berkshire Hathaway's cash reserves reached $382 billion. Again, cash levels low, arguably the best investor up to this date. Has stocked up on tons of cash. Just really think about this, okay? The only way one should buy stocks is if you understand the underlying business. You stay within the circle of competence. You buy businesses you understand. One business that I've bought more of this week, last week, was Advanced Auto Parts. It's at good prices here, and I'm not gonna go deep into it right now, but it's an easy business to understand. Okay, they sell auto parts at their retail stores. Um, but there's a whole turnaround story behind it. Um, but yeah, again, that's not for everybody. This is just my opinion on what I think is a good opportunity. Speak to a financial advisor before you make any financial decisions. I'm not liable, responsible for any of your um actions, and yeah, this is all for educational purposes only. All of those patients came in with symptoms like bloating and nausea and hadn't seen a pancreatic specialist. I think you can say 100% say AI saved their lives. Panda, their AI tool developed by DAMO Academy, detects pancreatic cancer early, even when CT scans, even when CT scans raise no alarms. Early detection changes everything. Isn't that great? What the hell? I feel like just imagine if a U.S. company, a big tech company, had an AI tool that helped detect pancreatic cancer early. Imagine, dude, like I can't even imagine like what. Oh my god, bro! Just imagine if this was a U.S. company, bro. I feel like everybody would be rushing to buy that stock, rushing, and it's crazy, man. It's crazy. This is I ain't fucking selling, bro. I ain't selling, man. Oh God, where else? Where else? Consumer confidence survey stock price is higher in 12 months. So what? 52% think that stock prices will be higher in 12 months. Okay, we went over that. Here's a very long-term trend line of the Dow Jones Industrial since 1899, going all the way up here, and here's a zoomed in, poked out, went up a little bit higher today. Yeah, just something to look at. Okay. When was this? What was that? Oh, here. Oh, we got something similar going on here. So, like a rising. This is not really a rising wedge, but you get it. There's a trend line there. Here we got the rising wedge. And then 90%. Okay, I don't think. I don't know, but yeah, it's just look. Don't pay attention to these percentages right here in this comparison right here. Just pay attention to the trend lines, to the white trend line and this trend line here. Okay, just pay attention to that right there. Anyways, the options market is expecting low volatility for the next days, but pricing in more volatility for payrolls and CPI in early January. The largest one-day implied move expected over the next several weeks is for the FOMC meeting in late January, which we think is appropriate. Um, yeah, it's been kind of boring. The real risk, but again, if there is a big move that the market isn't pricing in, expect a big move in those options. The real risk in 2026 is that inflation picks up, especially in the US. Our inflation sector basket has started moving higher while G7 inflation rate has bottomed. Okay. That note. Now there's more things that we skipped over. So yeah, this is a trend line of the US dollar. Testing right there. Support could break down, could bounce, who knows. Just keep an eye on it. 2025 return percentage. Korea 97, outrageous. Taiwan 36, Europe 32, emerging markets 31, China 28, APJ 27, Japan 22. They don't even mention Latin American countries. Those did very well as well. And then USA 16. Again, notice the broadening in market performance. I'm not talking sectors in the US, I'm talking globally. You think the US markets had a good year? No. Look at international markets. Early signs of investors finding the new toys abroad. Nudis. Okay. The number of patent applications in China is currently ranked first in the world. Damn, man, that's crazy. And then US is going down, so a lot more people are working on innovations and all that type of stuff and filing for patents over there in China more than in America now. So China. Value versus growth dynamics have been divergent between the US and Europe. Europe value has been outperforming since 2023. US value has been underperforming versus growth since 2023. I think, well, let's see what happens. This, okay, right here, US value. So typically, you'll see your Europe value versus growth do less well than US value versus growth. In this case, it's the complete opposite. So either Europe value versus growth is going to come down, or US value versus growth is going to go up. And I think it's the latter. Worst performing stocks of 2025 in the US. These are the ones. Big events, and then percentage decline from 3-year high. Recessions are the biggest ones. Okay, recessions are the biggest ones. AI data centers are often more power intensive than traditional data centers. A traditional rack in a data center is equivalent to the electricity consumption of 3 houses, while high density rack for AI uses electricity equivalent to 80 to 100 homes. Meeting future power needs from data centers, manufacturing facilities, and EVs likely requires large-scale deployment of grid infrastructure and power generation assets across the United States. Nuclear power, renewable energy, energy storage, and hydrogen fuel cells are among the solutions that utilities and companies can utilize to meet rising demand. For investors, we believe this creates an opportunity throughout the entire U.S. electrification value chain, from grid developers and technology developers to traditional and alternative electricity generators. And a note on that, let's go to our Generac section. Generac expands its commercial and industrial manufacturing footprint with new facility in Sussex, Wisconsin. New facility will help Generac serve the booming data center growth and other core industries with capacity for large-scale backup power generation and energy solutions. Let's see. Facility will enable the company to expand its manufacturing footprint for its commercial and industrial products, which have delivered strong year-over-year growth in recent quarters. Combined with Generac's new state-of-the-art plant in Beaver Dam, Wisconsin, and its expanded operations in Oshkosh, Wisconsin, the Sussex facility underscores the company's ongoing investment in scaling capacity to meet growing demand for power. All right, with global demand for data center capacity projected to more than triple by 2030, the rapid expansion of data centers is creating unprecedented demand for reliable and scalable power solutions. Uniquely positioned to meet that challenge as a trusted brand focused on backup power solutions for more than 65 years, our commitment to aggressively invest in serving this booming segments offers a generous opportunity for Generac, potential of doubling our sales of CNI products in the next 3 to 5 years, expands manufacturing capacity and operational flexibility, enabling us to support all our customers. Addition of large megawatt generators to Generac's global product portfolio has enabled the company's entry into the rapidly growing data center market, where power demand is expected to increase significantly for the foreseeable future. Six, expanding the product lineup to increase these large. Okay, again, let me read this title. Generac expands its commercial and industrial manufacturing footprint with new facility in Sussex, Wisconsin. It will help Generac serve the booming data center growth and other core industrials with capacity for large-scale backup power generators and energy solutions. And you know what I found crazy? I found crazy how cat has been cat stock has been Caterpillar stock has been going up a lot. Went up a lot 2025, and a big reason for that is their backup generators for data centers. But Generac is getting no love for that. Now I understand Caterpillar is more than just generators. They do a whole other stuff to build the infrastructure um for these buildings. But a big reason for the hype is data center demand. But Generac is getting no love for this, and I also understand that Generac does more residential generators than big commercial generators. However, um, this is a good step to increase their capacity for commercial generators. And I think the market realized this today. Generic is up around 5% or 4.5% today after this news, but it's still, in my opinion, very very um, unappreciated, underappreciated, and very 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 under the radar in terms of play, in terms of generator. Fuck, in terms of a generator play for data centers. So yeah, about um, never mind. But I'm gonna be honest. I'm bagged. I'm bagged in some call options. I bought them back in October. Yeah, back in October. January, March, and June. Um, at like 160, and then in November, and then 2 weeks into October, the price spiked to 200, or I think I bought at 170. Price spiked to 200, and then it dumped down to 140. So instead of averaging down on calls, because at that time I was playing a technical setup, and then with the dump, the technical setup broke down, and I was unsure where this was going in the short term. So what I did instead was, instead of averaging down on those calls, I bought a ton of more shares. I pretty much like doubled or tripled my position in shares. I even averaged up. I had a way out lower cost basis of like 124. Now my cost basis is like 142. Um, but I honestly really don't care because, dude, the this energy problem for the U.S. It's only going to get worse, and it's gonna get worse. And Generac, I think, is greatly positioned for to take advantage of this. and I don't care if I move my average from 124 up to 142, and if the stock goes down to 100 again, if it goes down to sub 100, I really don't care because I have a plan. And I'm gonna gobble up some shares. If it ever goes back down to those prices, I'm gonna gobble up some more shares. Um, but yeah, and then I'm still holding those options that I'm bagged in, but I don't care. If it reverses, and then I get to exit even, and then I'll replay. I mean, I'll retry different options and play the move up. But yeah, again, nothing is financial advice, opinion only. Talk to a financial advisor. Educational purpose only. Okay. Chinese households now have available cash totaling 160 trillion yuan, the equivalent of more than 2022 trillion US dollars. Man, I'm telling you, bro. The Chinese consumer is is piled up with cash. So back a few months ago, start of the year, but then I brought it up in April again. I had a thesis that passive investing in Meg 7 will go on to underperform small and mid caps. Um, and for the Meg 7 part, five of the Meg 7 stocks underperformed the market this year. Um, yeah. Chinese researchers have developed an all optical AI chip called Ligen that outperforms NVIDIA's leading hardware by more than 100 times its speed and energy efficiency, especially for generative video and image synthesis. Nice. Some bear market facts and historical corrections. 83% of historical corrections start between May and October. 111 days is the average correction length. May and October. But two of the corrections have happened in January. I see some conflicting stuff because I see that January is like the third. I guess it could be both true. That January is like the third most bullish month of the year. I don't know. Anyways, timing plus length of the correction. Average is 111 days. Shortest being 14. Longest being 289. Um, but yeah, average is 111. But most would be yeah. Overview of bear markets. Average cyclical bear market 198 days. One started in January, one started 3 in February, 3 in July, 1 in okay. Average secular bear 689 days. Okay. Timing plus length, cyclical bear. Average cyclical bear. Yeah, it's just a bear graph. The most bullish period of the year is October 28th to January 18th. It accounts for half of the S&P 500's gains since 1950. That's really interesting. Okay. One chart that I think is ready is Goose, Canada Goose. It's up like 5% or 4% today. I'm going to make another video. I'll maybe upload it again today, later tonight, or tomorrow. But I'm going to take some time today. It's going to be dedicated just to charting. I'll either go record the whole charting process, going through every company that I have on my list, or I'll chart on my own, and then I'll compile the charts that I find interesting, and then I'll just go over those. Yeah, I'll just do that. Save you some time as well. Advanced auto parts will be one of my main focuses for 2026. If it can get over the short, medium term EMAs on daily, weekly, monthly frames, this can be a big, quiet money maker. If so, AEP, Canada Goose, and Etsy. For the US, I think have like really good potential to make some silent big moves this year, in my opinion. Chinese companies lose money to their customers. JD losing the most money, Babo second to most, and Meituan the less. If the historical pattern holds, the winners of the AI era won't be the indebted builders of the early years, but the companies that arrive later to build transformative businesses on top of the chief, commoditized capacity left in the boom's wake. So new companies that come in after, or companies that already exist that use AI. As the heavy firms underperformed in all sectors. Mag 7, the new utility. So underperform, right? And now it's these big tech companies that are going to become asset heavy. Or not like CoreWeave and Lowe's, I mean. The Mag 7 are being forced to abandon the asset light business models that fuel the dominance. The irony to this whole thing is that the big tech companies who are actually creating this technology are in many ways actually worsening their position competitively. Hybrids and EVs make up growing portion of all U.S. car models. Some 30% of the car and truck models of the U.S. market now have an electric motor, up from 90% in 2020. This is good for who? Lithium producer who? Lithium player who? Albemarle, which is up 130% on our commons position since entry. Partially or full electric cars reach 25% of U.S. sales. Quarterly auto sales show internal combustion. Yeah, it's a very slow increase, but it's there. So EVs, hybrid. Yeah, so lithium needed for that. You know what else is lithium is needed for? Energy storage. And what comes with energy storage? Generators. I just get so excited thinking about this. Albemarle. Man, I should have bought more Albemarle, but whatever, it's hindsight. Hey, whatever. Generator. Oh my god. But lithium though, yeah, like the reason why I didn't buy more is because it's very cyclical. Um, but yeah, we got Albemarle for the lithium. We got Generac for the generators. All in due time, it's gonna work out. And then yeah, I think that's it, guys. I still haven't. I have more reading that I need to do. Um, some charting I need to do again. So next video will be just charting, and then I'll do the reading part, and then after a few days, after I've compiled some more things, I'll record another video. But yeah, so I have some better lighting. Hopefully the mic wasn't static this time. Better mic. Um, I think I have the volume kind of low though, so I might not sound that loud. And yeah, and then this is the small camera that I bought. I'll probably upload like short, like YouTube shorts, or like TikTok videos that are gonna be more edited, not this format. They'll be very short, 1 minute videos, probably going over one certain topic each video. It could be like, oh, like I I really like Generic for these reasons. Da 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 da. And that's it. Or oh, I'm really watching the game carry trade because of da 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 da. Whatever. Or these are the reasons I think um big tech stocks are going to underperform. Da 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 da. Boom, like this stuff like that. Because in these videos we go over a bunch of other stuff. I mean, a bunch of different things. And then in these videos, I'll probably do small, short videos, concise and clear. But yeah. Thank you for watching. Like and subscribe. You can find my Substack at JBDino. I might have changed it though, so I think I changed it. You can still find me there, I think. And if that doesn't show up, then just put JB and D. So JBD, sorry, JBANDD. Okay. JB. Yeah, I need to update these handles because I changed it. Because yeah, I'll go over it in another video. But just I'll update it. But you can probably find the links, updated links under this video. Okay. Anyways, yeah. Thank you for watching, guys.